Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by John Kensington, who is the Head of Financial Services at KPMG. They've got their annual Financial Institutions Performance Survey out, which you can see here. So we're here to talk to John about that. Now, John, this year you've done quite an interesting editorial in there, I guess in defence of banks and bank profits. I guess firstly, we'll just touch on that. I mean, what sort of made you want to write this piece?
Sure, Gareth, it's a good question. After 4 years of editing the document and many years being involved in it prior to that, I think what I've seen at times is criticisms that are perhaps, when you look at the absolute micro situation, might be applicable, but when you look at the bigger picture, perhaps I felt some balance was required. And so really it's around trying to put some balance around and I think educate people about some of the, what might be misnomers about some of these facts that are out there. And
you sort of concluded it by talking about perhaps treating banks more as we would winning sports teams or Olympic medalists, which is a fairly strong comment.
That might have been a bit passionate, but I guess what I was getting at was we have many sports teams and Olympic medalists that we really do revere here in New Zealand and respect and we think of as great people. But our banks are amongst the best in the world. They have the strongest credit ratings in the world. They haven't required a government bailout, and their businesses have been well run such that they are now in a position to allow New Zealanders to lend at rates that are phenomenally low, to allow them to do that whatever business they like to do or borrow for private purposes. So you've got a sector that's highly competitive. It's got a cost to income ratio as low as any in the world, and it's able to source funds that allow New Zealanders to undertake their business. Now, if we want a successful country, and more people are talking about things like prosperity and success, then probably the backbone industry will be agriculture, and that will drive the economic engine, if you like. You could look at the banks as being the oil in that engine. Without them being in good shape, the economy will not do as well.
I guess, just to have a bit of a look at that, I mean, they absolutely didn't need the bailout in the crisis. And most people would acknowledge it's good to have profitable banks rather than ones that are collapsing. But I guess they did have the wholesale and retail taxpayer-backed guarantees, and they were largely domestically focused. I mean, I guess in Australia and New Zealand, 4 big banks, very dominant in their home markets. Mm-hmm. So those factors played a role too in them coming through the crisis well.
Certainly. I mean, I think if you look at those banks, they were, as you said, domestically focused, which perhaps meant they didn't get involved in some of the, with hindsight looking back at them, silly deals that overseas banks did get involved in. But remember, the banks didn't ask for the guarantee schemes. They sort of got it by default. With Australia implementing their guarantee schemes, if the New Zealand government hadn't done the same, at a time when people were very scared and very worried about what was going on in the economy, your New Zealander with a little bit of money on deposit might have gone, well, hang on, I've got it in an Australian bank here in New Zealand and it's not guaranteed, why wouldn't I move that deposit to Australia? So you might have seen, if we hadn't put in a government guarantee, an exit of money that would have tightened up our economy to a point where we experience some of the difficulties that other countries in Europe are now seeing.
Now, moving on, you've touched on, I guess, the issues in the housing market at the moment, especially here in Auckland, and possible options the Reserve Bank might look at to try and cool things there. You've raised the idea of a capital overlay. Can you just explain how that would work and why they might look to implement that particular tool?
Sure. And I think what the Reserve Bank have said is they are a little concerned about the Auckland property market and potentially in the future with Christchurch. And if they see heating up in that market, they'll look at other tools available. One that might be available would be the capital overlay. And what it says basically is if you want to lend at the moment a mortgage to a customer, you need to carry adequate capital in your balance sheet to be able to do that, and a percentage weight, how much you have to carry. An overlay would say, well, at the moment, a mortgage is 100% weighted. If a mortgage is of a type that the Reserve Bank deemed maybe undesirable, you might see the Reserve Bank say that the bank needs to carry a higher level of capital. For example, they might say an 80% mortgage we will 100% weight, a 90 or 100% mortgage we would attribute a higher weighting, so therefore more capital required. In a way, it's just kind of a warning or a deterrent to the banks that if you're going to do that type of business, you need to have more capital.
And you've also noted that bank funding costs have come down. Do you have any estimate of by how much they've come down or anything like that?
Not really. I think what has been the biggest thing in the funding cost market has been the fact that there haven't been any shocks in Europe or the US, and that market has been opened and remained open and allowed banks to access it, which has it led them to be able to get funds. And because our economy and our banks are AA rated, they do so at reasonably good rates, and they're attractive to foreign investors. Remember, a lot of countries have interest rates of 0.2%. So if you have $100,000 in the bank, over a year you get $200 back. So our highly rated banks, AA rated banks, paying 3.5% are very attractive to foreign investors. And so that's really where I think more of the pressures come off, in that there has been more money available to New Zealand banks.
And you've also talked about how banks are fighting hard for customers to retain their own,
Sure.
as well as obviously try and win ones off other customers. That's really become a theme in the last couple of years, I guess, with a relatively low level of credit growth compared to what the banks
Sure.
had got used to. I'm just curious as to, do you have any anecdotes that you've picked up on that from the banks, and what impact do you see that having over the medium to long term, perhaps on their net interest margins?
I think the two anecdotal stories that we've heard when we've been around and talked to a number of the chief financial officers, chief executives or chief risk officers in the banks has been that if you have a good customer that is paying their interest and their principal as they're supposed to, and you suspect that they're coming under the watchful eye of a competitor, banks are even now starting to think about voluntarily going and talking to that customer about a slight rate reduction, an extension of term to keep them on board, as opposed to having the predatory competitor go in there and offer a much lower rate and ending up with a bidding war. I think in terms of margin, that will in the short term put on some squeeze on margin. But the reason the banks are doing it, if you've got a large, good customer and you lose that customer, you're going to have to replace them with someone else. And you may not get the same quality or the same size. You may have to do more deals, and they may not be of such quality. So that's really the logic behind it's really competitive forces at play.
And you're talking about business customers and residential mortgage customers?
Yes,
Yep.
yes. We have heard one or two comments that the rates quoted in the window can be bettered if you are doing things at a low LVR or you represent a very good credit risk. So the market is very competitive at the moment, very competitive.
And one of the other things that's come up in your report is, I guess, the increasing regulatory cost of both in time and staff, as well as, I guess, there's a financial side to that as well that the banks are facing. We've had the anti-money laundering legislations obviously coming in, FATCA,
Yep.
lovely word, the open bank resolution, Bail 3, all these different things that are
Sure.
coming in. What are the banks saying about all of that?
What they are not doing, Gareth, is raising their hands, cheering and clapping. I think there's a couple of messages here. The first is that they don't actually see the regulation as bad, and they see it good that New Zealand has it. I think what they are a bit concerned about is so much is coming at once, and in many situations we're seeming to introduce it early, ahead of when perhaps the parent company, bank's country has introduced it, which would allow them to then leverage off that and have lower costs. That's probably their number one concern. Their number two concern is really around, well, hang on a minute, if we are truly at the bottom and we've bumped along the bottom and we're going to go up in terms of economic growth, then it's time for banks to be innovative and introduce new products. And they're saying at a time when we're struggling for new products, there's a challenge for us to get resources to get these new products. It seems a little bit unusual that we're spending most of our new resource on complying with new rules. So it's that trade-off between I have to comply and get the resource to do it versus I'd really rather spend that resource on innovating and producing new products.
And I guess for some of the smaller institutions, these issues are even more significant, some of the savings institutions in particular?
Yeah, they are. Particularly in the credit union area, these costs are a far greater impost. So, for instance, the non-bank deposit taker regime requires certain things, and there'll be a certain set of costs that apply to all businesses. If you're a bank with a large business, it's easier to absorb those costs. if you're a smaller institution, those costs can actually be quite a significant impost.
And in terms of the finance company sector, you've noted that they've grown their total assets for the first time since 2008. So things are certainly looking up there. Their funding costs down as well, and profits up.
Yeah, and what you now have in the finance company sector is some companies that are experts in their niches. So whether they are a vehicle finance company or an appliance, consumer goods finance company, you have long-established finance companies that were there well before the GFC, performing very well, are still there now and are operating very well in a niche. They have got their businesses well under control in terms of costs. They run a very efficient ship. The message coming from them actually was, we would love to grow more quickly. Organic growth is slow, and the survey shows that. We'd love to buy something and bolt something on. But their concern is getting into a field they don't understand. So if they're a car financier, they're very concerned. They buy something, but it has maybe some property loans in it or some personal loans in it. So those businesses are profitable because they're well run. They'd love to grow, but very, very worried about how they do it.
So what's your outlook for the rest of 2013 based on what you've gleaned from compiling this report? I mean, are we going to see a pickup in lending growth? Are we going to see things sort of muddle along as they have for the last couple of years? What's going to happen?
Well, we have a partner in the survey, and it's Massey University, and they would show that lending growth is going to continue to grow, but slowly, not at the double-digit figures we had back in 2006 and 7, but in low single-digit figures. And I think I would agree with that. That won't be helped if the shock's in Europe. And I think different sectors will grow at different paces. The finance companies will grow in the niche that they're in, the banks will grow in the areas they're in, and may even start to compete with the finance companies in some areas. Perhaps the one area that I perhaps see some concern for is the credit unions. We've seen a few mergers there now. They do need to merge to get critical size, and they are probably the one area of the three sectors, the one that's under the most pressure.
Thanks for that, John. That's John Kensington at KPMG, and I'm Gareth Vaughan at interest.co.nz.